I will start with crowdfunding, a topic that not many exchanges are well aware of, and on the other hand, we also think it's nothing for us. It's something for the crazy internet community connected with social media. But that's in reality not true. Of course, there are some crazy ideas. For example, if you have a look here, there was a project asking to invent a banana piano, where you use bananas to play piano on your computer. They approached banks asking for $25,000 to start productions. Would you invest $25,000 in a banana piano? Or in an apple piano? So you can imagine the bank said, no way, we will never fund something like that. It's not a business case, nobody will buy it. What we did is, we put it on the internet. We're asking for $25,000. 2 weeks later, we had 500,000, where people trusted them. And we even didn't offer them shares. No, what we offered them is the system, how to connect the bananas to the computer. And it's currently sold for $50 per unit. They created 10 jobs. As you can see, there are good ideas, crazy ideas, but which make economical sense and which even help to increase employment. You may say 500,000, that's for our exchange nothing. But in an emerging market environment, companies who have a base capital of 500,000 US dollars are already medium-sized ones. I'm coming from a small country, from Austria, where you would say our large-scale companies are in the European context smaller, medium-sized ones. So even Austrian companies would be very fancy to get $500,000. Another example is a watch manufacturer producing a so-called e-paper watch, a plastic watch. You would say nothing innovative behind it. What we did is we supplied it with an Android and iPod application, went to banks asking for money to start production. We failed, based on the credit crunch, based on Basel III criteria, and so on. And they only needed 100,000. 2 months later, they had 10 million. $10 million raised over the internet without offering any equity in the exchange, in their company. What we gave them was, if you donated $10, you got a picture with a signature. If you donated $90, you got a watch. Currently, manufacturing started, the watch is sold for around $100. Would you, as exchange, have allowed them to enter your SME market? Probably not. And we got 10 million. What I would like to show you today is that crowdfinancing can be a business case for an exchange, for any exchange. You may say, okay, currently the regulatory regime does not allow us to raise capital via the public without the prospectus. But that is the world of crowdfinancing. If you see here, the definition of crowdfunding is quite simple. You raise capital via public means, mainly the internet, and using social media to marketing the products, the services of a company you would like to fund. There are different stages in the development of a crowdfunding platform or the financing you can provide. It starts with donations, goes up to pre-financing of crazy ideas or good ideas or production ideas, to loans, to equity investments, and the last stage, currently not offered anywhere, would be a crowd IPO. Now, what is the current situation? Many exchanges build up SME marketplaces, niches. Some are very successful, some are not. The fact is that in emerging economies, around 98% of the companies are small or even micro companies. And there is a financing gap, meaning they can't access finance easily. Bank loans after the financial crisis are very hard to get, or we have been in countries where if you ask for $100,000, you had to provide collateral for $120,000 or even more. Smaller companies are normally paying higher interest rates than the larger ones. So the financing environment for the whole SME sector is at a very bad stage currently. Regular capital financing doesn't work. Have in mind the two projects I just presented before. Imagine the company managers are going to an investment bank asking for their help to list on an SME market. The first one was asking for $25,000, the second one for $100,000. No investment bank is interested to bring small companies to the exchange. No chance. But on the other hand, you see there is investor interest. The first one asking for $25,000 got $500,000, $500,000. The second one asking for $100,000 got within 2 months $10 million. And now is the question, why exchanges are not pursuing this opportunity? Exchanges are here to allocate capital, to match capital demand and capital supply. So it would be more than logic to offer as an exchange a crowdfunding platform. It's the business line. And in the long run, it will help you to build up an IPO pipeline because the company will advance. It may start up based on donations. The next step will be raising capital through an IPO on an SME platform and then advancing maybe even afterwards to the blue chip market segment of your exchange. So there's an opportunity, but the opportunity is currently not used by the exchanges. You may say, it will never happen because our regulator doesn't want it. We have no chance to go forward. But for every problem, there is a solution. And some countries are more advanced than other ones. Clearly, there is a need of change in the legal environment. And some governments realized that capital market policy is also location policy. Normally, the companies tend to build up their headquarters in the country where they can raise the capital needed and where they find the right employees to work in their companies. The US government took the opportunity and approved in April last year the Jobs Act, Jumpstart Our Business Startups, jobs, creation of jobs. We defined new measures, how to implement it and how to make it possible either to have less reporting requirements for the companies or even to offer them the chance to raise capital over the internet in form of crowdfinancing, crowdfunding. And here you see some details. We defined what is an emerging growth company. We defined the maximum turnover they can have. It's $1 billion. So in the case of emerging markets, that would be a blue chip company, not an emerging growth company. They also defined that crowdfunding investments over the internet are allowed. So as a new company or an established one, you're allowed to raise $1 million per year if you provide financial audited statements and $500,000 per year if you provide unaudited financial statements. Larger exchanges would say, I'm not interested to have a company there which raises just $1 million, which raises just $500,000 per year. But if you add up all the companies which may come to your market, then you will see that they can generate revenues for your exchange as well. Another argument we often face is investor protection. Also, the Jobs Act, for example, takes care for investor protection as it defines specific investment thresholds depending on your income, annual income. So if you have less than $100,000, you are allowed to invest $2,000 or 10%, maximum 10% of your annual income. If you earn more, it goes up to 10% of your net annual income. And, of course, connected with this is a decrease of a regulatory burden. That means less reporting requirements, and depending if you have financial or audited financial statements or unaudited one, that shows what are you allowed to invest. Now, is it really a business case? The exchange's role, as I said before, is providing access to capital. All the means are in place. You have a marketing department. You may have a trading system, which may not fit because it's too costly, but also an easy-made internet platform already would be sufficient to establish the new market segment. You have the people who are knowledgeable in the area of market surveillance, who can read balance sheets. So all the infrastructure and also personnel is already in place on your exchange level. And you are losing money each month you are not providing crowdfunding facilities. Because as you can see, currently crowdfunding facilities are taking between 5 to 7.5% of the raised capital. And if you consider, for example, Kickstarter, which is the largest crowdfunding site in the US, they raised more than $300 million in 2012 with investors coming from 177 countries. And they took 5% of the raised amount as provision, as fee. Can you imagine 15 million more revenues on your exchange? And the money is coming indirectly as foreign direct investments directly into your companies, because the capital is raised in more than 177 countries, which this offers new financing opportunities for your startups, for your small and medium-sized companies. And it will help to increase employment in your country. And it will increase foreign direct investments by smaller shareholders, which don't have any political interest. We are interested in the products and the services of our companies. If you think further, the first part, the raised capital fee, is mainly based on donations. Here we don't see any dilution in shareholdings. The next stage would be to offer equity investments, which is, for example, possible according to the Jobs Act already in the US, and to think on secondary market transaction of those micro, small and medium-sized companies on your exchange. And the third stage would, of course, be crowd IPOs. And additional revenue streams can come from market data sales, as well as from licensing of indices specially focused on crowd-funded companies. So what's next? You're very well placed. Emerging economies have a need to finance small and medium-sized companies. Current SME market setups don't provide the capital needed by those companies. So it's up to you to act now. So if you have any questions, I'm more than happy to answer it. And I hope it was a little bit interesting for you and show that going away from the conservative thinking of the current exchange industry, going to innovative instruments may help your economy to grow and may provide sufficient sources of capital to support the economy. Thank you.